Welcome to the class. Myself N.K. Thukral from Edupedia World. What is stock exchange? Stock exchange is one of the important constituent of capital market. Stock exchange is an organized market for the purchase and sale of industrial and financial security. It is a convenient place where trading in security is conducted in systematic manner, that is as per certain rules and regulations. Now students, let's go ahead. What are the number of stock exchanges in India? In India, mainly there are 3 stock exchanges which are operating. Number 1 is Bombay Stock Exchange, number 2 is National Stock Exchange, and number 3 is over-the-counter exchange. Now let me brief you what are the objectives of Bombay Stock Exchange, National Stock Exchange, and over-the-counter exchange. Bombay Stock Exchange is the oldest exchange in Asia. Its history dates back to 1855. Let me tell you how it started, how it was recognized by Government of India. First of all, it's way back to 1855 when 5 stockbrokers would gather under banyan tree in front of Mumbai's town hall. The location of these meetings changed many times to accommodate an increasing number of brokers. The group eventually moved to Dalal Street in 1874 and became an official organization known as the Native Share and Stockbrokers Association in 1875. Now further, on 31st August 1957, the BSE, that is Bombay Stock Exchange, became the first stock exchange to be recognized by the Indian government under the Securities Contracts Regulation Act. In 1980, the exchange moved to the Dalal Street Fort area, Bombay. In 1986, it developed the BSE Sensex Index. Sensex means where all the stocks are displayed and their prices are given on daily basis, giving the BSE a means to measure the overall performance of the exchange. In 2000, the BSE used this index to open its derivative market, trading Sensex future contracts also. The development of Sensex options along with equity derivatives followed in 2001 and 2002, expanding the BSE trading platform. This is what Bombay Stock history is. Second stock exchange is National Stock Exchange of India. National Stock Exchange of India's history is that it was incorporated in 1992 but started its operation in 1994 with trading in the wholesale debt market segment. In November 1994, it launched the capital market segment as a trading platform for equities. Further, in June 2000, it entered futures and options segment for various derivative instruments. A nationwide fully automated screen-based trading system has since been set up at NSEI. In a nutshell, or in conclusion, we can say that it is the latest, most modern and technology-driven exchange. The NSEI was established by banks, insurance companies, financial institutions, and other financial intermediaries. The board of members of NSEI consists of senior executives from promoter institutions and professionals who do not directly or indirectly trade on the exchange. Objectives of both Bombay Stock Exchange and National Stock Exchange is to ensure equal access for investors all over the country with the help of appropriate communication network, to provide fair, efficient and transparent trading of securities through electronic system, to set up a nationwide trading facility, to enable book entry settlement and short settlement cycles, and to meet international benchmark and standards. Now the third one is OTCEI, that means Over-the-Counter Stock Exchange of India. Over-the-Counter Exchange of India can be defined as a stock exchange without a proper trading floor. All stock exchanges have a specific place for trading their securities through counters, but the OTCI is connected to computer network and the transactions are taking place through computer operations. Thus, the development in information technology has given scope for starting this type of stock exchange. What was the need? Why, when there was BSE and NSEI and they were operating and they were giving their trading facilities, why the need arises for over-the-counter exchange? I may tell you that Many small companies in India are finding it difficult to raise adequate capital through stock exchanges as the conditions stipulated by them could not be fulfilled. The companies must have run for minimum 3 years and they must have earned profit, and the minimum capital requirement for listing is also quite high. These were the conditions put by the National Stock Exchange and Bombay Stock Exchange. But hence, by promoting a new stock exchange with flexible conditions, the small and medium company in India will be now able to raise sufficient capital. Once these companies enlarge their resources, they can list themselves in the regular stock exchange. That is what the history and what was the need for over-the-counter exchange. Now students, after giving the brief history of BSE, NSE and OTCI, let's go ahead and see the Securities and Exchange Board of India. You see, now let me tell you that what is SEBI, what are its functions, what is its objective, why it was created. Security and Exchange Board of India is a regulator for the securities market in India. It was established in the year 1992 and given statutory powers on 12th April 92 through the SEBI Act 1992. So how you can define SEBI? What is Securities and Exchange Board of India? SEBI is an apex body for overall development and regulation of the securities market. You see, the main purpose of SEBI is overall development and regulation of the securities market. Further, I may tell you that SEBI has its headquarters in business district of Bandra Kurla complex in Mumbai and his northern, eastern, southern and western regional offices in New Delhi, Kolkata, Chennai and Ahmedabad respectively. It has opened local offices at Jaipur and Bangalore and is planning to open office in other states also. Controller of capital issues was the regulatory authority before SEBI came into existence. So, before SEBI, controllers of capital issue was the regulatory authority on the securities. However, SEBI derived authority from the Capital Issues Act 1947. Initially, SEBI was a non-statutory body without any statutory power. However, in 1995, the SEBI was given additional statutory power by the Government of India through its amendment to the Securities and Exchange Board of India Act 1992. The SEBI is managed by its member, which consists of the chairman, 2 members, officer from the Union Finance Ministry, 1 member from RBI, and the remaining 5 members are nominated by Union Government of India. Out of them, at least 3 shall be full-time members. So this is what SEBI is, what is its role, I mean to say why it was created and what is the history. Now students, let's see what are the objectives of SEBI. Number 1 is regulation of stock exchanges. The first objective of SEBI is regulation of stock exchanges. That is, to regulate stock exchanges so that efficient services may be provided to all the parties operating there. Now let us come to the second objective is protection to investors. The capital market is meaningless in the absence of investors. Therefore, it is important to protect the interest of investors. The protection of the interest of the investors means protecting them from the wrong information given by the companies in their prospectus, reducing the risk of delivery and payment, etc. Hence, the foremost objective of the SEBI is to provide securities to the investors. Third objective is checking the insider trading. Insider trading means the buying and selling of securities by those people, directors, promoters, etc. who have some secret information about the company and who wish to take advantage of this secret information. This hurts the interest of the general investors. It was very essential to check this tendency. Many steps have been taken to check insider trading through the medium of Securities and Exchange Board of India. Now, next objective is control over brokers. How the brokers can be controlled. It is important to keep an eye on the activities of brokers and other middlemen in order to control the capital market. To have a control over them, it was necessary to establish the SEBI. So, SEBI was created for meeting all these objectives. So, these were the objectives of SEBI, and let us go ahead and see what is the role and what are the functions of Securities and Exchange Board of India? Number one role is or function is to regulate and control business in stock exchanges. Regulatory function is these functions are performed by SEBI to regulate the business in stock exchange. SEBI has framed rules and regulations and a code of conduct to regulate the intermediaries such as merchant, bankers, brokers, underwriters, etc. Further, I may tell you under this, the SEBI has framed rules and regulations and a code of conduct to regulate merchant bankers, brokers, etc. These intermediaries have been brought under regulatory purview and private placement has been made more restrictive. SEBI registers and regulates the working of stockbrokers, sub-brokers, share transfer agents, trustees, merchant bankers and all those who are associated with stock exchange in any manner. Second function is to make registration and regulate functioning of intermediaries. So earlier I told you that SEBI registers and regulates the merchant bankers and all those who are associated with stock exchange in any manner. So SEBI registers and regulates the working of mutual fund. SEBI regulates takeover of the companies and SEBI conducts inquiries and audit of stock exchanges. So these are all the functioning of the SEBI to make the systems foolproof. Another function of SEBI is to register and regulates working of mutual funds. And another role is to promote self-regulatory organization of intermediaries, as earlier I told you in case of regulation and control of business in stock exchanges. Next function is to regulate merger, takeover and acquisition of companies. So whenever companies wants to merge among themselves or one company takes over another company or in case of acquisition, the regulations, regulatory measures are there and all the companies needs to be complied with. Another is to prohibit fraudulent and unfair trade practices of intermediaries. So to restrict and avoid fraudulent and unfair practices, the intermediaries have been brought under regulatory purview and private placement has been made more restrictive. Another is issue guidelines to companies regarding the capital issues. So in case of IPO, I mean to say initial public offer or raising capital issues by the companies, the guidelines are framed by the SEBI and that needs to be followed before coming forward in public for getting the capital by the companies. Another is to conduct inspection, inquiries and audit of stock exchanges. Whenever SEBI wants or wish that and has some doubts on the companies, they can conduct inspection at regular intervals or as and when the inquiry arises and make inquiries and audit of stock exchanges on quarterly basis or yearly basis. Next function is to restrict insider trading activities. As students, I told you about the insider trading activities. Insider is any person connected with the company such as directors, promoters, etc. and they have any information about the meeting and they can take the benefits. So to avoid this insider trading, SEBI has made suitable guidelines. I may tell you that is directors of a company sometimes may know that the company will issue bonus share to its shareholders at the end of the year and they purchase shares from the market to make profit with bonus issue. This is known as insider trading. SEBI keeps a strict check when insiders are buying securities of the company and takes strict action on insider trading. So these are the objectives, I mean to say role or functions of SEBI. Now students, let's see what are the terms used in stock exchanges. What are the terminologies? Number one is primary and secondary market. Now students, let me tell you what is primary and secondary markets. Why it is word used primary and or secondary markets. There are two types of stock markets in India, primary and secondary market. Primary market is where a company issues its shares for the first time when it wishes to raise capital or expands its business operations. This is done through initial public offering, that is IPO. Now come to second market. Second market, people buy the shares of the company already listed on the stock exchange. To carry out online transaction in the stock market, you need a demat account also. So this is what the secondary market means. Any investor can buy the security of the company of the stocks which are already listed in the stock exchange. Now students, next term used is bullish market, and also next is bearish market. These all are the two markets are interconnected. Either market is bullish or bearish. What is bear and what is bullish? The term bear and bull describes upward and downward market trends. Bearish market refers to decline in the market, while bullish market refers to rise in the share market. Investors generally follow a buy low and sell high strategy. This is what bullish and bearish. Bullish means upward, bearish means downward. Next is book closure. What is book closure means? Book closure is the period during which the transfer in the share of the company will not be considered and it will be recorded only after the end of the closure period. It also means closure of register of members for the purpose to finalize the list of members entitled to receive dividend or right or bonus shares. Next is record date. Another term is record date. This is the date issued by the company for the purpose of determining shareholders who are entitled to receive the dividend. If a company, suppose, announces 20th December 2013 as record date, and I am holding the stock in my demat account on this date, then I am entitled to receive the dividend from the company on this date. That is a record date. Another is bonus shares. A bonus share is a free share of stock given to current shareholders in a company based upon the number of shares that the shareholders already owns. After the bonus, the number of shares held by each shareholder increases, but the value of the total shareholding remains the same. Next term used is right issue. A right issue is when a company issues its existing shareholders a right to buy additional shares in the company in proportion to their holding. The shareholders have the option whether or not to subscribe to the right issue. Usually right issues or shares are offered at a discount current market price to encourage the shareholders to subscribe to the issue and also as way of rewarding them. Another is short covering. Short covering refers to buying back of a security in order to close your open short positions. Assume you had created a short position in Reliance Industry by selling 100 shares at Rs 800. Currently, suppose the stock is trading at 700. The trade is profitable for a trader and he will cover his position by buying back 100 shares at Rs 700 and make a profit of 10,000. So this is what short covering is. Another is insider trading. Insider trading is buying and selling of securities by a person who has access to information of company which is not public. Already we have discussed enough on insider trading. So students, this is all for today. These are the terms used in stock market normally. So let's wind up today the chapter on stock exchange. Already we have discussed enough and briefly I have explained you everything. That's all today for the class. Thank you. Bye bye.